Welcome, everyone, to the Unlocking Alternative Growth Capital webinar. Thank you so much for taking time out of the day to join us. I want to go over a few things about our platform. This is an open Q&A session. I know that you cannot speak as an attendee. However, at the bottom of the screen, there is a speaking bubble with a question mark in it, and you are welcome to ask questions along the way throughout the session. Our panelists will get to those questions toward the end of the webinar. So make sure you ask all the questions that pop into your mind. We can't wait to cover those topics with you. For now, I'm going to hand this over to Ken Kaplan, who is the moderator for this event. Ken?
Thank you, Diamond. Hello, I am Ken Kaplan. I founded Kaplan CFO Solutions 15 years ago. Our firm works with companies that are in a state of transition. Most often, these companies are not yet large enough to need a full-time chief financial officer, but need a financial expert in place to provide comprehensive strategy in addition to financial oversight and management. These clients typically use one of our Kaplan CFOs from 8 to 12 days a month to manage and guide the financial side of their business. We are not an executive search firm. We take one of our 19 CFOs and put them on the client's payroll, making them a new member of a client's executive team. Thank you for joining this webinar, Unlocking Alternative Growth Capital. We developed the idea for this webinar because we've worked with many clients who have needed alternative solutions to traditional bank lending. Typically, this need becomes apparent when it's time to fuel exponential projected growth. While we have worked with clients to obtain alternative growth capital, we thought it would be best to learn about these offerings directly from the proven and very important trusted capital experts we have partnered with in the past. So let's introduce our panelists. They are for today, Chris Renno is a partner at JACS Capital Partners, John Stanier, a partner of Clarity Capital Advisors, and Logan Trotter of Salem Investment Partners. I'm going to ask each of them to take a few minutes to explain their firm and what they do. Then we will talk about how these forms of capital are used and their purpose. Then we will go through a list of questions for the panelists to answer, and we certainly welcome your questions throughout the process. And I will try to sprinkle in your questions as we get them, as opposed to waiting towards the end. So Chris, we're going to start with you. I'm going to ask you to talk a little bit about you and your firm.
Thanks so much for that introduction. My name is Chris Renno. I'm a partner at JACS Capital. JACS is a family office. We're based in Asheville, and we invest primarily equity investments in the broader Southeast. We have a thematic interest and focus in healthcare and energy, but we've made diverse investments outside of those particular industries. We can participate from, first check into a business that's, pre-revenue, all the way through a growth equity round. Generally, we look for investments where we could also provide strategic value, leaning into the business, supporting the team as they grow. And that includes helping them raise follow-on capital, which might be additional equity from larger equity funds, growth equity funds, private equity funds, or debt as well. Investing at the stage where we invest, generally we put a lot of focus on the founder, the team, and the idea. So that becomes a priority in terms of how we evaluate whether or not we'll be making an investment. Excited to be here today to have this conversation.
Great, thanks, Chris. I'm sure a lot of folks didn't know that we have really a family office like this making equity investments right located in Asheville, North Carolina. So that's very exciting. John, you're next.
Thank you, Ken. Thank you, Kaplan, for sponsoring this today, and glad to be a part of it. So my name's John Stanier. I'm a partner with Clarity Capital Advisors. And our firm is an investment bank. We're actually based in Atlanta, but I have the privilege of being able to spend most of my time up in the mountains of North Carolina, up in Asheville. So that's the connection with Kaplan CFO. So Clarity, we're an investment bank that serves the lower middle market. So the companies we're normally working with are anywhere from 10 million to 75 million in revenues and positive EBITDA up to $15 million of EBITDA. So slightly more mature companies. They're not usually startup companies, although we do try to help startup companies whenever we can. And Clarity was founded in 2020 in partnership with a regional accounting firm called Hancock Askew. Hancock Askew is based in Georgia. They have about 350 professionals and a couple thousand clients based across the Southeast, and 9 offices from Atlanta being the biggest down to Miami. We're now actually part of Hancock Askew, and later this month we'll be rebranding Clarity as Hancock Advisors. But as I said, we're an investment bank. We provide corporate finance advisory services. So clients come to us looking to solve a problem. They want to grow. They want to revamp their financial accounting systems. They are getting prepared for a potential change of control event. And so we work with our clients, to help them think through and prepare and plan for those situations. And then a majority of the work we do is working with our clients as a sell-side M&A advisor. So these are usually family-owned, founder-owned businesses that are looking for a partner, looking for a change of control. Maybe the founder's family isn't interested in running the business going forward. So majority of our business is helping these clients, find a partner, find somebody who can buy them, and that can range from financial buyers, so private equity firms, family offices like JACS, and financial sponsors such as Salem, who you'll hear from later. We're generalists. We work across lots of different businesses in the market, anywhere from business services to manufacturing, healthcare services, logistics, telecom services. So we see lots of different businesses and business models, and we've been very successful over the last 4+ years, helping our clients achieve outsized outcomes and selling their businesses. And the final thing we do from time to time is we actually work with some of the financial sponsors and help them identify opportunities to purchase companies to add to an existing portfolio company or a new strategy they're executing. So, Ken, thanks again.
Sure. Logan.
Good morning, everyone. My name's Logan Trotter. And Ken, thank you for inviting me to this. I'm grateful to be here this morning, so thank you for that. I have been with Salem Investment Partners for a little over 10 years. Salem, we have 2 offices. I'm actually in the Charlotte location. We also have another office in Greensboro. There's 13 professionals in our firm, sort of split evenly between the 2 offices. We're formed in 1999. We have sort of a Southeast focused of the types of investments that we do. And we are primarily a mezzanine or junior capital provider behind a bank, usually, and in front of the equity. And we also make minority or non-control equity investments. As I said, we were formed in 1999. Over the course, we have 3 current funds active with about 60 investments across multiple industries, primarily business services, light manufacturing, distribution, consumer products, healthcare, just mostly Southeast focused, Mid-Atlantic, and the Midwest. We have, across the 3 funds, we have about $350 million of investments outstanding across about 60 names.
Great. All right. Thank you very much. All right. So, John Stanier, I'm going to ask you to explain what really do we mean by alternative capital and how is it used?
Sure. Thanks, Ken. So when you think about, an early stage company, a company just starting up, the first thing that they likely do is they go out and they raise some sort of, startup common equity, maybe from friends and family, maybe from an angel group, maybe from, local investors. But the first capital that a company usually raises is some form of equity. And likely that can be common equity. So as you think about the capital stack, we're going to talk about it from the earliest capital raised to raising capital in later stages, and in terms of where it stands in seniority, so in liquidation, where it stands. And so common equity is usually the first capital that's raised. And in terms of, a payout, if they sold the business, you would start at the other end of the capital stack and pay everything off before the common equity had any proceeds from a distribution. The second form of equity, most common form of equity, is some type of preferred equity. So usually after a company has gone through the startup phase and they're raising capital from outside investors, this could be a venture capital fund, this could be a private equity group. They're raising some type of preferred equity. And all that means is it's senior to the common in liquidation, and it could, or most likely has, some additional terms and bells and whistles to it. It may have some type of dividend associated with it, fixed dividend, and it also may have some type of preference, i.e. they get their money before the common, and they may get 1.5 times their initial investment before the common gets any distributions. And again, that's usually when you're bringing in some type of institutional type capital. So somewhere between the common and the preferred equity and the senior and mezz debt is convertible debt. So convertible debt is a hybrid between debt and equity, i.e. the name, and it's usually done when young growing companies aren't quite ready to raise money in a large equity raise. And so they'll raise, sometimes it's called a bridge financing. So they'll raise money in the form of convertible debt. This will usually have some type of coupon that's not paid in cash, a short-term maturity somewhere between 1 and 3 years. And that debt is either, payable at maturity or payable upon some type of event. Usually the company has been successful in raising, say, a preferred equity round, and the convertible debt holders will have the option either to be repaid or to convert their convertible debt into the equity, usually at some discount to what those usually preferred equity holders are investing at. So if they're investing at $1 a share, the convertible debt holders would have the option to invest at 80 cents a share. Next in the capital step, well, first I'll go to senior debt. So senior debt is traditionally bank debt, it's mortgage debt, it's a revolver. It's something whereby the lender is secured by the assets of the company. So at a point at which, and there may likely for smaller companies or personal guarantees, but the point at which that company has fixed assets and the wherewithal to be able to secure some type of senior debt that can be secured as well by inventory or other assets. So think of it as traditional bank debt. And junior to that, which Logan will talk about in detail, so I'm not going to spend a ton of time, is subordinated debt or mezzanine debt. So this is debt that is junior to the senior debt. It may have a second lien. Many times it doesn't require a personal guarantee. It'll have a higher interest cost, and it may have some warrants attached. And it's usually used for growth capital or for recapitalizations. So think of it as slightly more expensive, but more flexible debt and cheap equity. And so with that, I will turn it back to you, Ken.
Okay, great job, John. Logan, can you explain to our audience when they should consider these alternative capital sources and what really is the purpose of alternative capital?
Sure, Ken, thank you. So the way we live in sort of in the private credit world as I think that gets a lot of attention these days in the marketplace. I think business owners think about us as subordinated or bank-like debt that carries a higher coupon, like John mentioned. It is generally more flexible than senior debt, and we're more growth focused. So as where a bank is leaning on the source of repayment or their collateral as the working assets of a company, we really focus on the cash flow generation of that business. And so that's how we sort of view the world, as more of how am I going to get repaid through the cash flow ability. I'm not looking to the security or selling of an asset or in liquidation to repay me. So as a business owner, really the range of our capital supports initiatives that is not really well suited for banks. And those typically come in the form of organic or inorganic growth. And so for organic growth, that would mean, a company's growing faster than the bank is willing to lend them more money. They don't want to sell a portion of their business to a private equity firm or some other type of equity investor. And they would like to have, and their company is growing fast enough to where they can support an additional debt load that a bank won't provide. So for example, it could be the introduction of a new business line, a new product development. It could be R&D. It could be hiring salespeople. There's a lot of things that our capital is used for to help a company grow. Other sources or uses of our capital are for acquisitions, and that can be a business combination. It could be a management buyout. It could be a private equity firm or sponsor buying a business. We're part of that conversation. The other sort of, I'm going to say, general category are recapitalizations and or an owner or shareholder transition. So that would be, as John mentioned earlier, some of the smaller companies, they could be founder owned and control. They may be approaching retirement age. They may want to de-risk themselves by selling a portion of their business to a third party. They may be transitioning out and selling it to the other members of management, and they want some liquidity. So we can facilitate those types of transactions too. It's really, our investment decisions are based on the cash flow, the ability of the company, and not necessarily the assets, as I mentioned. And, we can provide, it's really more specific purpose use capital.
Great. Thanks, Logan. Chris, do you have anything to add to that?
Yeah, I think as well, and we're going to get into this a little bit later, but I think it's valuable when the capital could potentially bring something to the table that you and your team are lacking. This is potentially a little bit more on the equity side, but if there is an area of expertise, a skill set, a network that an equity investor can bring, I think that's also likely a good time to explore that as an alternative form of capital. That's going to be probably differentiated from what you can get, at a bank and what they offer from their lending officer. They won't often have that much additional strategic value for the company as it seeks to grow.
I want to add to that. I think that's a really strong point. There are, for many small businesses to get to the next hurdle, there's some form of help that business needs. It could be to get to the next level in terms of the type of customers that you want, or you might need help with with a certain type of supplier or foreign suppliers. And so a lot of times I've seen, especially equity investors, that can really provide that level of help. So we don't think of them just as financial sources. And Chris is right. We will get into that in a few minutes. Chris, while I've got you here, I'm going to ask you, and then I'll go to the other panelists as well. Are there minimum amounts that capital sources are willing to work with?
So I would say more organized kind of angel investment groups and funds probably start around 100,000 or so for equity investments. But a lot of those smaller investments will likely be to get to know a company with the hopes of potential follow-on at a later date. There is a possibility to raise smaller checks from friends and family. I would add that a word of caution when considering that. One, sometimes like a lot of really small checks can muddy up a capital table, which makes it potentially gives pause potentially later on when larger institutional rounds want to invest, or there's an acquisition. If there's 30 people that all own an equity stake, they might not have all the rights that they think they have, but they could complicate a process in a larger round or a sale. And additionally, sometimes some of those smaller checks might, it might be a $5,000, $10,000, $15,000 check, which might be a large investment from them, and they might think that warrants them, weekly sales updates or things like that you don't want to provide. So again, from like a institutional perspective, I would say angel investment groups and like smaller funds probably start around 100K or so when they're looking to make equity investments. But generally that again includes follow-on, and much less than that. I would just think through if that actual capital is required and if it'll cause more complications.
Logan, what could you add to this?
Sure. So I would say the average profile of a company that we invest in has revenue between 10 and $100 million, EBITDA of sort of 2 to 10. So we view ourselves as institutional capital. We are investing in, I'm going to say, later stage companies, established companies. They have an operating history. They're cash flow positive. They can support, additional debt. They can service debt. So when we think about minimum capital, I think our minimum check is probably $2 to $3 million, and it goes and I think the max we'll invest is 12 to 15 million per company.
Great.
And that can be in a form of debt and or minority equity and or warrants. And a warrant is like getting the benefit of equity through a security but it's not direct ownership. So it's like a synthetic equity position.
All right, John,
that's sort of our investment range.
John, would you have any?
I would just say, and I know it's frustrating. So for early stage companies, younger companies, they'll say, I just need $750,000. I just need $1.5 million. That's some of the hardest capital to raise. So just, know that, once you're looking for more scaled investments of, 3, 5, 10 million, there are a lot more providers out there. There are a lot more options. So it's, we understand your pain and, can try to help, but it can be challenging.
Okay.
Yeah, that's a good point, John. We get a lot of calls, $1 million, $1.5 million, $2 million. And we typically, for us, we have a committed fund. So we are going to put 25 to 30 investments in that fund, and writing a $2 million check is the same amount of work as writing a $10 million check. So for us, we prefer to go larger. And you're right, when you're trying to find that $1 million, $1.5 million, that's hard capital because it's bigger than sort of the friends and family round, but it's not big enough to attract institutional guys where there's, a lot of people like us out there.
But I think that's the value of mezzanine debt, because as a CFO, the owner says, well, I only need 750,000, or I only need $1.5 million. Well, would it be a lot better to get, if you can raise 3 in mezz debt, what it would be better to have more than to have less, right? It'd be better because you don't know exactly what you're going to need. So it seems to me that, as a business owner, if you think you only need 2 million and the mezz lender is saying, well, my minimum is 3, I'm not so sure you shouldn't go with 3. Is that a fair statement, Logan?
Yes, we're not here to really just put money on the balance sheet and collect a coupon, but at the same time, we do recognize that things may cost more and take longer to do, right? So we want to be realistic about what the capital need is. And if it requires less and we have the opportunity to grow with the company, it's not to say we wouldn't write a smaller check kind of the first time through again. So
right, we
can look at something as a little smaller, and then, hopefully a year from now, there's other opportunities to increase our investment amount.
Exactly.
Especially if it's local. If it's in the Carolinas or somewhere where I can get in the car and go see it in a couple hours, that's fine. In my backyard, I'm not going to go to California for $2 million check.
Sure.
It's just
Makes
too cost
sense.
prohibitive for do all
Yep.
that. Just a lot of friction costs there. So anyway, but yeah,
Thanks.
no, you're not wrong about that.
Okay. So we kind of mentioned this earlier. What should a business owner look for in an investor outside of money? So Chris, again, we'll start with you on this.
Yeah, I think especially at earlier stages, it should be a kind of a two-sided street. You want someone who is going to be a partner for your growth, someone who you can talk to. I think across our investments, maybe there's a handful where things have just gone according to plan and like done really well from the get-go. But I'd say the vast majority of them, things targets aren't met, something happens, there's a problem in Q3, whatever that might be. So having a capital partner who you feel comfortable kind of having those conversations with, working through it, I think is really important. Some of the things that I think are particularly valuable when you're looking for additional capital is strategic knowledge of the industry. Does that team or individual, have they had work experience in that industry? Have they made investments in that industry? Have they written checks into business in that industry? Because those connections and experience can accelerate your earlier stage company's growth and get it where it needs to be. And then I think the last bullet, the long-term commitment to growth, I think is really important. If you're aligning yourself with the right investor at any stage, hopefully with that first check, they can provide additional capital and follow-on checks, or make transition to more institutional funds more seamless for you and your business. We always try to work with the companies that we invest in to connect them to strategic investors, to larger growth funds. And being able to do that, I think, is something that helps businesses where they're focused on executing, and an investor can really support them through the financing component of the business.
Great. John, would you have anything to add there?
Yeah. What I would add is I would echo what Chris said. Is it's really important, whether it's equity investor or lender, to understand, the character of your partner. And when things are going well, that's great. Everybody's happy, but you want to find out, and it's hard, but you want to find out references of customers, investments that they've had where things didn't go well, and how they worked through them, and what that capital provider was like as a counterparty, because that's really the most important. How is my best new friend here who's written me a check gonna act when things go down or sideways. So that's, I think, the most important thing I would add.
Yeah, I just agree totally with what John said. I would ask for references just to state it again. I think I'm always happy to introduce companies to founders that we've invested in, want them to know what we're doing, what we've done. So the ability to, speak with 2 or 3 other companies who've worked with a fund or an institution, I think is a great call out, John.
Well, folks, we added this question because a lot of the business owners we work with, are really reluctant to add third parties, especially equity-based. And, we understand that somebody is buying a share of your business. They're not necessarily buying a controlling share of your business, but they're going to have, and we'll discuss this later, they're gonna want to have some vision into your business to some degree. So, but this can be a positive thing, not a negative thing. I will tell you, in my 40 plus years of business and raising capital, whether it be traditional bank lending or some of these alternative forms of capital, it rarely goes, the company, our operating companies, typically struggle that first year after they've raised that money. It just seems to happen that way. So you're going to learn pretty quickly how that relationship is. I don't mean to be negative. It's just something that's going to happen. And I think it can be really positive, because then you're going to have, if you found the right partner, you're going to have somebody that's really going to support you in tough times. And there will be, we all know this is business. There's always tough times, not all the time, but you're going to find them eventually at some point. All right, so we'll move forward here. Let's see, Logan, can you help us and explain, certainly for your in your firm, how are fees structured?
Sure. Well, so I'll speak to the mezzanine side of the market. It's a fairly, it's a fairly commoditized market. So I think there's the fee structure. So just kind of perspective wise, mezzanine lenders like us, there's probably 150 of us in the country. We sort of all specialize in similar things in terms of how we lead. Our typical investment is a loan, and it's typically 5 years long. It's typically interest only for a period of time. As John mentioned, we're behind the bank. We may have a second lien on the assets of the company. We may not. So our fees are really, an upfront fee of 1% to 2% of the loan amount. There's other costs associated with us coming in and doing diligence and I guess underwriting the loan, and that would just be our legal expenses. There's also, we validate the management team, and so there's some background checks that we do. So we bring in some third-party guys to sort of help us with our due diligence and underwriting. We do a quality of earnings report, which is generally just hiring our accounting firm to come and basically validate the EBITDA of the business, because that's really the focal point of what we're underwriting to. So that's, so it's a fee up front. And then it's our coupon, which is just our interest rate, and whatever other ancillary fees associated with getting the transaction closed.
Great. Chris, what would you say, or how are fees structured in your world?
Yeah, I think generally there's 2 structures that are kind of common at the earliest stage: safe agreement and convertible debt. We're going to walk through those, but those documents are pretty ubiquitous in their use and don't require that much legal expense. So writing checks with those generally wouldn't incur fees. For equity investments, a price round would be our expectation that the part of the equity round would be recouping the legal expenses for drafting those documents for that priced equity round. So that could be, anywhere from 5,000 to usually 20,000 at the most complicated deals. for our stage in terms of what the legal costs we would anticipate recouping would be.
Okay. John, how does it work? How does it work with an investment banker?
So stepping back, so first, as Logan and Chris have said, there'll be fees associated with the capital you're raising, and there'll be transaction costs, and those can be covered by the capital raise. And then to the extent someone's using an intermediary, whether it's a broker or an investment bank, those fees can range from 1% for an introduction to 5 or 6% if it's a equity raise, and so there are costs associated with having a third party help you facilitate a transaction. The commercial from our side is, especially for smaller companies, you all have day jobs and night jobs that keep you 150% busy. And so, it's one thing to say, yeah, somebody called me up and they said they want to buy my business or they want to put money in my business. It's another thing to get, a term sheet, to get the check in the bank. And that can be anywhere from 3 to 6 months. So, having somebody assist you in that is usually worth their weight in gold, and the price that capital comes at more than covers the cost. So.
Yep, I agree with that wholeheartedly. Folks, we're a little more than halfway through this. I do want to encourage you to submit some questions if you have any questions. So we'll continue here. What rights or control does an investor generally require alongside their investment? Chris, can you start us off there?
Yeah. So generally, if we're doing a price round, that usually includes a board seat for the price round, along with some protective provisions around future financing. So the business can't, raise, additional capital or potentially even additional debt sometimes without approval of that first equity investment. So that's primarily designed to protect the equity investments, but for founders, it's a real thing to consider when you're having these initial investments, because it can handcuff you in a way that you might see the situation differently. Then the informational rights and anti-dilution protections are pretty common. Informational rights, quarterly reports or financial reports from the business. A lot of that flows through the board seat as well. And anti-dilution ties into sometimes the protection provisions so that you can't raise subsequent rounds that reduce the initial equity investment stake unduly. Liquidation preferences is sometimes often overlooked when founders are raising their first equity check. If it's a preferred equity round, you might get a 1x preferred return, which means if the business is raising at a $20 million valuation, and then 5 years down the road things didn't go as planned, and sells for a $10 million valuation, the equity holder might not have their equity stake cut in half. In that situation, if they had a liquidation preference, they might be able to recoup their entire initial investment before the rest of the common is paid out. Sometimes the preferred might have a 2x or even a 3x preference, which means that before anyone else gets paid out in the common equity, that equity investor has to be repaid twice their invested capital or 3 times their invested capital, which in an upside scenario doesn't always matter that much, but in a downside scenario could eat up a lot of what that sale price could be.
If this seems a little much, I would like to remind our listeners that this is very early stage capital. And so the investor, is really taking a tremendous amount of risk because of the fact that it's early stage capital. So yes, these are provisions that they're going to require, and I would say some of them could be negotiable. For example, the anti-dilution protection. I think Chris used the term that you cannot dilute unduly. So it doesn't mean that they're hard and fast, but it would be something that you would that you'd probably want to negotiate or have your attorney negotiate.
Yeah. And to that point, I think a lot of the investments that we're making, there's not a clear path of cash flows that are going to repay and grow into the future. There's a lot of foundational risk on whether or not the company will be around in 4 or 5 years.
Right, because if we remember that capital stack, you're coming in much earlier than, let's say Salem Investment Fund is, a mezzanine fund where the company is certainly more established. So obviously there's much greater risk. John, is there anything you'd like to add there?
No, I sometimes this sounds overwhelming or scary. It really shouldn't be. And, you can, the company that's taking the investment, hopefully they have good legal counsel, but there are lots of ways to benchmark and just make certain that the terms that they're getting are certainly standard. So all of this is very standard.
Okay, great. This kind of dovetails into our next question. Logan, do mezzanine loans come with covenants like senior bank loans come with covenants?
So thanks, Ken. So generally speaking, and I'm going to dovetail the last question in with this question.
Yeah, sure.
Because I think it's sort of relevant. So when we're making a mezzanine investment in a company, yes, we have a set of covenants that are not unlike a senior lender, where we'll have a leverage test and a fixed charge coverage test. They're typically looser than the bank, than the senior lender. They'll require that so that we won't trip a covenant and cause a default before the bank does. So and that sort of dovetails into what happens if there is a default. Well, there's a lot of things that can happen in a default. If it's a covenant default or just a minor breach, that's not viewed as, well, I'd say for us, we're not a heavy-handed group. So I guess our view is when we get in and we make investments in these small businesses is we understand, Ken, you even mentioned this earlier, that these companies are going to have a bad day one day. It may not be tomorrow, but I mean, every small business is going to go through some downturn. And we recognize that. So we don't want to be heavy-handed or sharp-elbowed. We want to help them through that process. Our job as a capital provider is to be a good partner and to sort of know what they know when they know it. So is the issue something that's minor, or is it terminal? And if it's terminal, that's a different conversation than if it's just a minor problem. If it's a minor problem, maybe they're breaking covenants or they're underperforming. Maybe the senior lender just is waving their hand and saying, we're not comfortable with our exposure. Maybe there's an equity check to write. Maybe that comes from us. Maybe that comes from us and the owners. So, to put the bank back in their happy place. So that's sort of, or it could be, we want to work with the company to kind of get them through. There's no benefit to Salem to declare a default and accelerate into a liquidation of a company. That doesn't do anybody any good because I'm behind everybody else and I'm unsecured. So I'm just going to accelerate my way into a loss. So we look at things a little differently when it comes to making an investment in a business. That said, yeah, there's some strings attached to our mezzanine loan. We require monthly financials from our companies because we want to be more proactive. We're not looking for a personal guarantee. We're not looking for the assets. So we want to have monthly calls with the management team. We will always get a board observation right. So, and we don't want to be on the board generally. We're not here to be strategic. We're not here to get in the way of the business, but we want to know what the board knows and we want to be helpful if we can be. So those are, and if we have equity, either synthetic through a warrant or through a direct equity investments, we'll have the similar rights that were on the prior sheet or the prior page, where we'll have some protective provisions, anti-dilution. We won't have liquidation preferences, generally speaking, but we'll have provisions that sort of protect our investment. And so, Ken, I'm going to just, maybe I'm going in the weeds too much here, but for us, as I mentioned earlier, we're cash flow lenders. So we care about what the cash flow generation of that company and what are the calls on that cash. And that's, and there's only a handful of them. So we want to understand those and minimize those. So for example, interest and principal, those are calls on the cash. CapEx spend. So we may put a limitation or a governor on how much you can spend annually in capital expenditures. We have to pay the tax man. He gets his money. So, we got to understand that, are they a taxpayer? What are the calls on the capital for taxes? Distributions to shareholders. We want to limit those while we're involved. That's a negotiated point, but we don't want money leaving the business that would otherwise be available to repay us, because we recognize our debt is, expensive. So you want to pay that down as quickly as you can. Most prudent businesses want to do that. So that's kind of how we look at it. And our covenant package sort of reflects that.
Great. Thank you very much. I think that then dovetails. I remember you made a comment about warrants. So I'm going to ask John to explain, what are warrants for shares? What does that mean?
Right. So the warrants have been referenced a couple times in the conversation. So warrants are, as Logan said, synthetic equity, quasi-equity. They're contractual right that's usually granted to, say, a convertible debt holder or a mezzanine lender. It's usually when there's third-party capital coming in, there will be an equity kick or a warrant granted to the convertible debt holders, the mezzanine holders. And simply what that is a contractual right, an option for that warrant holder to purchase equity at a pre-agreed price sometime in the future. So it can be, oftentimes there's something called a penny strike price warrant. So literally it's a penny per share to exercise that warrant at some future date. And that can have a 5-year term. It can have a 10-year term. So it's an equity kicker for usually some type of quasi-lender. It gives them the right, but not the obligation to buy equity at some future date in the time. And usually that right is exercised prior to a liquidity event. So the company's selling or raising equity or through a recap. And so it's like equity, but it doesn't grant the warrant holder any equity rights until they exercise. So they won't have a board seat. They shouldn't, I won't get too mechanical, but there shouldn't be tax issues or anything until that warrant is exercised. So hopefully that's a simple way to answer the question, but if anybody has anything to add.
Well, no, John, that's exactly right. I mean, that's exactly what it is. And just for the audience's benefit, Salem's been doing this for a long time. We've made 150 or so investments. I think we've exercised our warrants, 0 times. So there's no benefit for us to own, generally speaking, when we make an investment in a company, we're getting a very small piece of that business, and we're just looking for the economic benefit that equity, that quasi-equity gives us. We're not looking for any of the voting or control aspects that may come along with equity. So it's just it's an economic incentive for us as we're going through, as we're negotiating our transaction.
Great. All right. So want to do an equity raise, let's say. John, how would a business owner value that business for an equity raise?
Right. So there are three main ways to look at your business and come up with a value for a business. So one's, very textbook. So you're looking at the discounted cash flow valuation. So you're trying to project out the future cash flows and what those will be, and look at what the present value of those is. And as I said, that's a very theoretical exercise, and it's often done as one of the ways to value a business, especially when you're having a professional valuation done. I can't say in the real world many people put much credence on a discounted cash flow valuation. So the other two ways are to look at public market valuation. So you say, okay, I own a grocery store, and where is Kroger trading at the market today, and how do I compare to that, and what discount should I put on my business, because I'm a $10 million business and Kroger's a multi-billion-dollar business. It's a guiding point, but for early stage companies, it is really a hard way to value businesses correctly. The most typical way is to take a look at the business, how it's performed historically, what the likely growth of that business is, and compare it to other private transactions that are being done in that space. So we call them private transaction comparables. You try to the best of your advantage or best of your ability, and it's hard to come up with what some private business was sold for a year ago. Usually they hold that information fairly closely, but you try to understand where similar companies are trading in the private markets. Those are the three main ways. And then to the extent there's significant additional asset value, you can also look at an asset value of a business. But for operating companies that are usually asset light, that's probably not the preferred way. But I know Chris and Logan probably have a lot to add here.
Chris?
Yeah, I think at the earliest stages, it really is an art, especially for companies that are, growing quickly. If you were to use some of their, financials from the last 6 months, they might think that discounts the fact that, in the last 6 months, they've doubled the revenue, and they have confidence that in the next 6 months, they're going to double the revenue. So I think it's about kind of finding a middle ground between the tools that John outlined, and working with your investor on an valuation that makes sense. I'd say at the earliest stages, most equity investors, when they're looking at modeling out how this business exits, they're going to be looking at 20% plus annual return in your business is what they're going to be trying to model backwards from. If it's at the earliest stage where they're calculating that there's a meaningful chance for this business to go zero. So trying to think through from an investor's perspective, how they're evaluating and modeling the business. If they give me, $1 million for 10% of my business today, how does that model out in 7 years to an exit that gets them, a 20% return? I'm not just saying to back into that valuation as a way to project forward, but I think it's important to have that in the back of your mind that is what an equity investor is going to be evaluating against. I think helps make the conversation a little bit easier. I'll also say that at the earliest stage as well, on the margins, I wouldn't worry wildly so about valuation when you're thinking about your first check and or your first priced equity round. A lot of those outcomes are going to be binary. Like, is the company, successful, or is the company not successful? Does it go from, $10 million in revenue and 500K of EBITDA, or no EBITDA at that point, to 3 to 4x that? So if you're looking, a few percentage points here and there, I think I have to remind myself this as well. It doesn't necessarily change the end outcome. those kind of really early financing rounds. But as you move further along and grow, and there's a lot more of a history, I think it does become more important to really lean on the tools that John outlined.
Gotcha. All right. Chris, are there different ways to structure equity investments?
Yeah, so we have a few examples here. A SAFE is it's an acronym for a simple agreement for future equity. What it does is it gives an investor the right to own equity in a business at a future date when there's some trigger. What this does for earlier stage companies, it gives them flexibility to kind of punt on what that valuation is. So if it's a relatively new and fast growing company and they need 250K or 500K or a few million, depending on the scale of the business, a SAFE agreement allows for investors to put money into that company, delay the question of valuation, and then when an equity raise happens, the investor is paid, quote unquote, for taking that early stage risk by getting a discount on what that price round is, or benefiting from a cap of the valuation. These SAFE agreements are really, I would say, founder friendly. Doesn't give the holder very much rights at all in the business in terms of what we were discussing before. But it enables investors and companies to move really quickly. It's a pretty standard templated agreement. So there's pros and cons, but a lot of risks kind of on both sides of that coin. And then convertible debt is a debt instrument that has some of the same benefits of a SAFE note. It allows you to put some money into a company without setting an actual valuation in it. During the term of the convertible debt note, it accrues a coupon, maybe 10%, maybe a little bit more in today's market. That coupon is not paid back to the investor during the term, usually in cash. It just accrues into the principal. And then when there is an equity round, financing round, a price round at a later date, that entire note can convert into that equity round with the benefit of that coupon and additionally a discount as well. And then a price round is the kind of when a business is probably a little bit further along, has some additional data where you're able to triangulate and work with a founder and investor to say the business is worth $5 million, $10 million, $20 million, agree to that valuation, and then allow the investor to add capital to the business and own a component of the business based on what the valuation was done at.
So this is very interesting because you really don't have to worry about what is the value of my company in these early stages. So I think that can be very helpful. John, do you have anything to add to that?
No, I think Chris covered that. Yeah. Convertible debt is a a nice sometimes way to fudge the answer when you don't want to have to come up with the hard answer on how's the equity price. So,
but I think that's really helpful because it's so hard to come up with that, at certain points of the business, especially the earlier times. So I think that's very helpful.
There's another benefit of both kind of the SAFE and the convertible debt as well, is if you're thinking about them as kind of bridge rounds or in between price equity rounds, it also gives you the opportunity to get to know an investor as well. So generally, if you're writing a SAFE note and or convertible debt, that entity might want to do the price round at a later date. So it gives you a ramp to potentially make an investment, get to know them a little bit more, which then makes the discussions around valuation for the price round potentially a little bit easier if things go well.
All right. Well, let's talk about when we exit the business. How does third-party capital change the way that we exit the business or what we get from that business? So I'll ask Logan to start with that answer.
Okay, thanks, Ken. We try to stay out of the way of that, honestly. It's not, so, we're debt investors, minority equity. We will have some rights as our equity or warrants will have anti-dilution and some protective covenants. And then on the flip side of that is that the owner, who's the majority owner, will have, drag along rights, which are generally he can control when he exits, and I just get drug along in a transaction. So I don't have a say about that. And that's fine. We don't really want to. We're not, if they want to sell the business, we're not here to impede that process. When that does happen, however, we're going to exit along the side of the shareholders. We are investing a lot. When we make our investment, we're investing in a company that we believe in. We're investing in a management team that we believe in, and in an industry that we believe in. And so if that fact pattern changes, meaning there's going to be a new management structure, new management team, we may or may not want to be around. And honestly, most of the time they want us to exit anyway because they've got their own capital providers, or they don't want to grow the business and leave me behind, as a minority equity owner, and let me benefit from the growth that they're going to do to the business. So we exit alongside the selling shareholders in 100% of the case, and we're not there to impede it.
Could the only exception to that be like a management buyout to an owner that's retiring, or would you generally get out at that point as well?
If we've been in it for a while and we like the management team, we've done that before, and we've actually supported the management team and put money in it. We've helped the management team buy it. So yes, we'll do that. We'd sort of flush out our existing dough, and then we'd recapitalize the whole business, right? So we'd start over again, because the company may have changed, and we may write a bigger check or not participate in the equity. So so yes, Ken, that we could roll into the new transaction in sort of a new kind of reset. And we've done that a few times.
Sure.
A management buyout's good for us, Ken, because, honestly, it's the same people that turn the lights off on Friday show up on Monday. And if we've been in it and we like the guys and we like the business, then that's not nearly as risky as a change of control where, private equity firms coming in and buying it and, shuffling people around and people leaving the business and hiring new people. That in our mind is a riskier transaction.
So you've done a number of management buyouts that you didn't own, that you didn't have an investment in. Is that correct?
Yes, we've done it that way. And that's usually more of it is that they would, a management, how you find these is sort of hard to pinpoint, but yeah, we've done them where, a management team is buying a business. They may hire someone like John to do a capital raise, and they reach out to us.
Gotcha.
And it could be the management team buying out a shareholder, a 10% guy, a 50% guy, whatever. And then they're just, leveraging the company in order to affect that transaction.
Right.
Hopefully that makes sense.
John, would you like to add anything to this question?
I think at a high level, let's assume you've brought in a later stage equity investor who has a significant stake. They're going to have rights, and their interests should be aligned with the management, the owners, on the timing of the exit, who it's sold to, and the valuation. So it really depends on how much capital you have, but their interests should be aligned if things are going well enough with the management team. So it's a win-win for everybody.
Okay. Chris, anything there to add?
Yeah, I think just when taking on equity investors, this is an important thing to understand in those initial conversations. How are they viewing the return, and when do they anticipate getting that return? Because equity investors, once they make that investment, generally it's kind of like a clock ticking in terms of them wanting to get the return. Some funds or groups anticipate returns in 5 years, some 7 years, some are happen to be patient long beyond that. But all equity investors at some point want that investment to be realized, and it's generally realized through an exit. I don't think earliest stage companies need to have kind of a crystal ball to exactly know, 7 years, 8 years, 10 years into the future, what that looks like. But having some directional sense and alignment, philosophical alignment at least, in terms of what the options are and making sure that the investor agrees with you in that perspective, I think is important to make sure there's as little conflict as possible when discussions of exit come up.
Yeah, I like to tell the story. Many years ago, I think it was the early 2000s. We had done a management buyout where I was part of management, and we raised a bunch of capital through a private equity firm. Actually, we raised through a private equity firm and a mezzanine lender. And all of a sudden, about 3 years later, we had a big medical supply company, Cardinal Health, come knocking on our door. And as a management team, the first time they came knocking, and they gave us a price, and we weren't really that interested. And they came knocking, I don't know, about 90 days later, and they gave us another offer. And we joked around and we said to each other, well, I guess we better tell the private equity firm that we've got this offer, because by that time it had gotten pretty strong. So, it was, initially we weren't that excited about selling, but it just got so interesting that, we certainly had to do the right thing and let everyone know. But, you always want to do the right thing. I just remember that that's like 30 years ago. I have seen a question come up, and I welcome more questions. This question comes from Alan Minker. It's a great question. I guess it would go to Logan. The question is, what are mezzanine debt interest rates running these days?
Well, thank you for the question. Right. Generally, okay, so I guess the trend in mezzanine, our rates are 11 to 14% kind of current, and that can be a combination of current pay and some small portion of PIK or paid in kind. But that's the general range. Rates have gone up a little bit over the last year and a half as interest rates or cost of money is not free anymore. So, yes, our rates have gone up a little bit. It hasn't gone up as much as bank debt has. But what we're also seeing is we're getting more warrants with the deals that we're doing to help us make up for our return. So if you want to look at the way if you understand the way we view the world, we're going to sort of assign a cost of our capital or what we want to make in terms of return. And maybe that all-in return is, let's just say, is 16%. So a portion of that is going to come from our interest rate, and a portion of that is going to come from an equity investment. And together, that's going to blend to 16%. And, with some projection 5 years down the road that we're going to exit. So the current pay portion has gone up a little bit. I'd say our overall underwriting yield has stayed the same. It's just been a shift from more current yield to warrant or equity. Hopefully that helps.
Thank you. Got another question, this time from Jen Bolton. What is this panel's recommendation for a small construction company, about $3.5 million in revenue, 35 years in business, that requires the cash to manage cash flow through seasonal projects? She's working to level out cash flow, but the company needs funding to get there. Obtaining a line of credit has been challenging, so they've utilized MCAs, which are very expensive. Anybody have any thoughts on that?
So this is John Stanier. I'll jump in. That's a hard world to live in. Obviously, if you work with a local bank to get you through those seasonal working capital flows, that's important. You wouldn't go out and raise equity to fund that. Gosh, that's a tough one because it's too early stage for mezzanine debt. won't say I'm stumped, but Logan or Chris, any thoughts there?
No, that seems tricky because to the point, it seems like potentially too expensive and maybe not the right fit for equity, depending on the growth trajectory of the business. But I will say I do think I'm seeing more high net worth individuals consider private credit as an option.
Right.
Get a meaningful coupon. It's going to be less expensive from like a fee and like friction perspective because it's individual and or individual office who can potentially move a little bit quicker, but finding that there's not a real structured way to go about and find those opportunities because
well, Chris, I think the comment that you made is the key here is the company's been in business 35 years and their revenue is only 3.5 million. So they're not a growing business, right? Or at least they don't seem to be at this point. The other comment I thought was very interesting, and John, maybe you can comment on this, because we really didn't talk about this in the capital stack. I am seeing more and more private debt type capital type start to emerge. Are you able to comment on that, John?
Sure, and I'm sure Logan can add to that, but there's a lot of capital out there, whether it's institutional capital or private investors. When you look at where the equity markets are today, and maybe someone sold a business or they've done well in the public market, so people have a lot of capital to invest. They're looking for yield, and so people who are a little savvier are looking to make private debt investments. So that's possible. Where you find those, there's no directory to find those people, but they're certainly out there. And Chris would see that in his world. And I just came across somebody sold a business for $15 million, and they're looking to diversify their investments, and they're looking to do a $1 million private loan. So we're seeing that more and more. It's going to look a lot like what Salem can do, just probably in smaller amounts.
Yeah, Jen, I actually might have a solution for that. So I've come across actually through, I think, a local Merrill Lynch broker who seems to have access to private capital. So we can certainly talk about that. Joe Panico,
I'd like to make a
Logan,
point.
Go, yes, please.
So, and I agree with that. That world, I don't know the dollar amounts or the need necessarily, or what the terms would look, or how long you need it. If you're talking about seasonal projects, that there'd be more to dig around in that. But you're right. I think it's too small for something like us to do. It's not really an equity. It would be a bridge financing type product through a private high net worth guy, and he's going to charge 15-16% for that, and he's going to want to get paid after it'll be a 1 year kind of renewal thing, probably. That's my speculation. In terms of managing cash flow for construction companies, what I've seen is that is a hard thing to do. A lot of people, what I've seen are doing, are actually taking deposits. So you got to help get some money up front if you can do that, in order to help offset some of that working capital need.
Good point. Very good point.
And people, have been reluctant to ask for that. I think that's a trend in the business, in the construction trades, because of what's happened in pricing over the last couple of years. It costs a lot more to mobilize on a project. You have to put, your labor cost has gone up. And if you're over here, billing it on a monthly or bi-monthly basis, and you're paying your people weekly, well, then you've got to work through that cash flow dynamic. And one way to do that is through getting a deposit up front.
Yeah. I'm seeing in the construction industry now, I know in Jen's case, she's not talking about residential construction or even like business or commercial construction, but I'm seeing deposits go up everywhere as a way to manage cash flow. So that makes sense to me. We have a question from Joe Panico. He asks, do the panelists find that certain size banks are better than others when trying to work with mezzanine debt? And his question, he says, is related to subordination agreements or intercreditor agreements. Are some banks kind of harder to work with? I guess this would be directed more towards Logan.
Can you read the question again? Because I don't see it on the.
No, it's not on there. He was having trouble submitting it, so he texted it to me.
Okay.
So, he says, do the panelists find that certain size banks are better to work with than others as it comes to, as opposed to working with mezzanine lenders? And I guess more specifically, he was talking about, when you've got subordination agreements or intercreditor agreements.
So, the quick answer is yes. There are sort of pros and cons to each. An intercreditor agreement is fairly standardized document today, and subordination agreements are fairly standardized as well. So, but not all. The size of the company and their relationship with their banking group. Maybe they help, it depends on their level of expertise or their experience with having someone have mezzanine as part of their capital structure. So sometimes it's an educational experience. We've had to deal with that where, the senior lender's never done it before, even though it could be, a bank that you would think could do it a lot. It just happened to come from a localized area that's not part of the corporate bank component. So it just sort of it depends, but that has and I'll tell you, if it's we have had instances where we've had to sort of close over a bank where maybe the senior lender and us couldn't agree on terms, and we had to take them out, and then we've got tons of relationships with banks, and then we come in and try to help find them a new bank. If the transaction is meaningful enough. So we've done that, a couple of times, but for the most part, we get there with the banks. And
I think that's a really interesting comment. You have tons of relationships with banks. Well, that's a good thing, obviously.
It is. Yeah.
Because, that, again, we talked earlier about, you're not just a pretty face or pretty money, right? You can really help. And a lot of times our clients, they get involved with one, maybe two banks, and they don't realize there's a ton of them out there that others of us have good relationships with. So the fact that you can help facilitate that, I think is really, really important.
Yeah, right. Well, I appreciate that, Ken, because there can be some friction points when you're negotiating the intercreditor agreement. And ultimately, we may have to go to the borrower and say, look, we're sort of, agreeing to disagree here. You either need to, you need to help us get to the finish line here, or we need to, either step back from the transaction, or we need to, go a different route with your senior lender. And oh, by the way, we have connection, we have banks as investors in our fund. So clearly we have relationships with those banks, and we can bring those to bear.
Yep. Great.
And of course, they're all, that's part of the reason why they invest in us, is to get some alignment,
right,
in relationships.
We've got another question. Wait, hold on, Joe. Is that a follow-up there? Okay, great. I've got a question from Bob. I don't know Bob's last name, but the question is the private credit provider typically familiar or even very familiar with the industry or the borrower? So in other words, yeah. So, do you have to really know that private credit provider? John, could you answer that perhaps?
Sure. And I guess I heard it two different ways. I think the first way was, does the lender know that industry well? And sometimes, they will have a specialization or know that industry well, and they've done, multiple things like it. Many times, these groups are generalists, and they're looking at a profile of a business in terms of revenue, of profitability, of growth. And so they don't have to be specialists. I think that's what I heard in terms of the question. Does that answer it?
I think so. Anybody else want to add to that?
So I'm happy to chime in. So, we tend to invest in companies that we can understand. If I have to pull up a Google, to understand, half the acronyms of what they do, then it's probably not a deal for Salem. So for us, we like the old economy stuff. We like, people that make things or sell things that if you drop it on your foot, it hurts, right? So yeah, and then part of that's because I'm old, but the fact is we do want to understand the industry, and we want, and we draw, correlations from that. So we've made 150 investments and across a lot of different companies. And so, we'd like to think that we have some familiarity with the industry, and we've been in that space, and that's usually helpful for the borrower to have some depth in there. Sure. Because we can understand the nuances. And it's not like we're trying to be strategic, but we're also don't want to have to ask a lot of stupid questions every time we meet about what they do. So yes, we're trying to be more so than a bank, for sure. Banks
I think it could go both ways depending upon the private credit provider. And Bob, I would say that if you're looking for a private credit provider, I'm going to volunteer John Stanier or myself. If you don't think you're really at the mezzanine, you're ready for mezzanine debt, something that Salem might offer, but you're looking for a private credit provider, I would think maybe John or I could help steer you in that direction. Yep. Any other questions? These are great questions, by the way. I'm glad to see that folks had some questions. These are really outstanding questions. Well, listen, we've put we have up here the contact information for the panelists, and so please take a minute to write that down. We really appreciate everybody's participation, and I thank you to the panelists. I think you did a fantastic job. I think we answered the question, right? I think alternative capital is clearly a it's not anything fly by night. It's been here for a long time, and it's not that hard to find. And so hopefully we've given some of our attendees ideas and ways that they can tap that source. So thank you very much, everyone, and we look forward to talking to you in the near future.
All right. Thank you, Ken.
Right.
Thanks.
Yep. Thank you, Ken. Appreciate it.
Bye-bye.
Thank you.
Thank you.
The webinar has ended. Thank you for joining. Goodbye.